In our case, in Roman 1 of that particular question, we are required to compute the basic earning per share. Basic earning per share. Earning per share, we abbreviate that using EPS, of which you're required to compute the basic earning per share for the first year, or for 2 years. The first year ending 31st July 2017, and for the year ending 31st July 2018. Now, what here we need to remember is the formula for computing now the earning per share. So to compute the earning per share, we take the profit, which in other terms we refer to as the earnings, attributable to the ordinary shareholders, and then we divide that with something known as the weighted average number of ordinary shares. Now, the weighted average number of ordinary shares, we abbreviate that using 1/2. Now, here what we need to remember is that when computing these earnings, or the profit which is attributable to ordinary shareholders, we are supposed to take the profit after tax, and what we are given here, we are given now the income of a group. Now, the profit after tax now which we take, and the profit after tax, this is the same with the profit for the year, So we are supposed now to take the profit for the year which is attributable to the parent company, because if you go back to the income statement, you'll be in a position to see that that profit for the year is actually split into the profit of the parent, the profit of the NCI. So therefore, we are supposed to take now the profit which is attributable to the parent, and then to that we less what we refer as the preference dividend. We less the preference dividend for the current year, for the year. So whatever we get now is what we refer to as the earnings, or the profit which is attributable to the ordinary shareholders. And then also what we need to remember is that when computing the weighted average number of shares, that is supposed to be computed by taking shares which were issued and fully paid at the start of the year, plus other shares which the company has issued in course of what? Of the year. Now, in our case still here, we also need to note that we are required now to compute the earning per share for 2 years. The first year here ended on 31st of July 2017, and the other year ended 31st July 2018. So in our case, we are going to start by computing the earning per share for the first year. So we start by computing the earning per share for the first year, that is year ending 31st July 2017. Now, if we go back to the information which we have there in that particular question, you'll be in a position to see that we have the income statement for 2017 and 2018, and then there below we have the extract of statement of financial position for 2017-2018, and then those particular transactions which we have in the additional information, we are told that those are the transactions for the year which ended 31st July 2018. 18. In fact, if we go through what we have there, we will be in a position to see that the first transaction whereby the company issued 100 million shares, it occurred on 1st July 2017. Not July, that is 1st November 2017. Now, 1st November 2017 is this year. Is that year? Because you will see that this year, the current year, started on 1st of August 2017. So therefore, that transaction of 1st November 2017 is a transaction for that. The transaction here, note 2, it occurred on 1st Feb 2018. Still, that is a transaction for the current year. Note 3 is about transaction for 2018, and note 4 is a transaction for 2018. So mean that the only information now which we have about now the year 2017 is the information which we have in the income statement, in the statement of financial position. So therefore, what we need to do, let first of all start by computing the earnings attributable to ordinary shareholders for 2017. So in this case, we are going to take now the profit after tax, the profit after tax, which you have said is the same with the profit for the year, and we should be able to get that from the income statement which we have there. So remember, in our case here, what we take here is the profit for the year, which is attributable to the parent company, company. So in the income statement for 2017, if we go there, we will be in a position to see that the profit after tax was 240, but there below, that profit after tax has been split into two. The profit which is attributable to the owners of the group for 2017 is 210, and the profit which is attributable to NCI, which is 30. So what you are supposed to use here is the profit which is after tax attributable to the parent company, and in our case you're given that as 210. So we don't use the full amount of 240. We are supposed to use only the profit which is attributable to the parent. That only applies in case of a group of companies. So then for this, we should proceed and we less the preference dividends, dividend for the year, and that one, if you go to where we have the extract of financial position, we will be able to see below equity we have something called 4% preference shares. Now in the year 2017, the 4% preference share capital was 100 million. So what that means is that the dividends the company was supposed to pay during that year should be 4% of the preference share capital, which is 100 million. So if we are to get a 4% of that should give us 4 million, and then we less that from the amount of profit after tax, and we should be able to get 206. So therefore, what we have there is now what we refer as a profit, which is attributable to the ordinary shareholders. Now, having computed, then we need to compute the weighted average number of shares. Now, the weighted average shares in our case of that this should be given by the number of shares which had been issued at the start of the year, and then we add the other shares which were issued. But what we have said, in the year 2017, the only information which we have here is about the shares, or basically about the number of ordinary shares which had been issued and fully paid at the end of the 2017. In fact, if we go back to the information, the statement of financial position extract is at 31st July 2018, together with the comparative for the year ended 31st July 2017 were as follows. Now, if we go back to the information which we have for 2017 there, we will be in a position to see the equity share capital was 200 million, and in that case we are told the par value per share is 0.5. So that means that having that information, then it is very simple to compute the number of shares which had been issued and fully paid at the end of 2017. So in terms of how we are supposed to compute the number of ordinary shares, or what in other terms we refer to as the number of equity shares, we take now the equity share capital, which is 200 million, and then we divide that with the par value per share, which is 0.5. That now should give us the number of equity shares which had been issued and fully paid as at the end of 2017. So we have 200,000 divided by 0.5, and that should give us 400 million. So these are now the number of equity shares issued and fully paid at the end of 2017. So having that, then to compute now our earning per share become very simple. That is to compute our basic earning per share. We take now the weighted average. We take the profit which is attributable to ordinary shareholders, and in our case we already have that, which is 206 million. 206 million, and then we divide that with the weighted average number of shares, and that is now what we have computed there as 400 million. So, and if we compute now the earning per share, we have 206 divided by 400, and that will give us shillings 0.515, which is shillings per share. Shillings per share. So that is now the earning per share for the first year, that year 2017. So having computed that, let's proceed and we compute now the earning per share for 2017. We compute the earning per share for the year which ended 31st July 2018, not 2017. So in our case, we use the same formula. We take the earnings or the profit attributable to ordinary shareholders, we divide that with 1. So let's start by computing the profit which is attributable to ordinary shareholders. We have said that this should be given by our profit after tax, and in this case I've said we should take the profit after tax which is only attributable to the parent company only. So we have that where we have the income statement, and first of all, the profit for the year for the year 2018 is 325, but it has been split into two: profit for the parent or the owners of the group, and NCI. So the profit which is attributable to the owners of the group is the profit which is said to be attributable to the parent company, which is 280 million. 280 million, and then now to this we less the preference dividends. We less preference dividends for the year 2018. This will be given by the preference share capital. If we go to where we have extract of statement of financial position, the preference share capital in this year still remain to be 100 million. So we should take 4% of 100 million, and this will give us 4 million. So we less it from that, and that should give us 276. So that is the earnings which is attributable to ordinary shareholders, and then from there we compute a weighted average number of shares, that is 1/os. Now the weighted average number of shares, this one will be given by the shares issued and free paid at the start of this year, of which this year we have said it should start from 1st of August 2017 and basically end on 31st of July 2018. So therefore we should take now the shares which were issued at the start of the year plus other shares which were issued in the course of that year. Now in our case, what we know is that the number of shares which had been issued as at the end of 2017 should be the same number of shares issued as at the start of the current year, of which in our case we have already computed those shares. Which had been issued and free paid at the end of 2017. That computation, we have it here, number of shares which had been issued and free paid at the end of 2017, which is 400 million. Now to this then we need to add the other shares which the company issued in course of the current year. Now that information, we have it in the additional information. Let's go to the additional information note 1. We are told 100 million shares, that is 100 million equity shares, were issued in relation to acquisition of another business. These shares were issued at full market price on 1st November 2018. So mean that on 1st of November 2017, not 2018, we are told that there are some shares which were issued at full market price. Now, whenever we have shares which have been issued in course of the year, and those shares have been issued at full market price, what we do is that we have to split those shares in, or those particular shares must be weighted on time basis. Now, the shares which were issued in our case, we are told they were 100 million. So, and we are told they were issued on 1st of November 2017. So if we are to count now the number of months we have here from the start of the year, so we know that the current year started on 1st of August. So we have August there, we have September, and then we have October. So that means that those particular shares were issued 3 months after the start of the financial year. So mean that those particular shares then were outstanding for 9 months during that year. So therefore, these particular shares which are issued in course of the year at full market price, we have now to weigh them on time basis for the period they were outstanding. So mean that we need to multiply that with 9 all over 12, which is basically proportion of time the shares were outstanding during that financial year. So if at all we are to compute that, we have to compute that, we have 100 million. We have 100 million times 9 divided by 12, and that in our case should give us 75 million, should give us 75 million. So then let's go to note number 2. In note number 2, we are told 150 million ordinary shares were issued for cash to existing shareholders on 1st Feb 2018. So mean that on 1st of February 2018, there were some shares which were issued now to the existing shareholders at a price of 1.5 shillings per share, which represent a discount of 25% on the traded price of 2 shillings per share immediately before the issue. Now, in our case here, if at all we are told that the shares were issued to the existing shareholders at a discount, automatically this now what we refer to as a right issue. What we refer to as a right issue. So that means that on this particular date here, the company made a right issue, issue. Now, whenever now the company make a right issue, the company would be issuing shares to the existing shareholders of the company at a price below the market price. And because in our case here, shares are issued at a price below the market price, then what we assume is that some of the shares are issued for free, whereas others are issued at full market price. And therefore, anytime now the company issue shares in form of a right issue, what we need to do is to split the shares issued into 2 components: the shares which are deemed to be issued at full market price, and those particular shares which are deemed to be issued for free. But for us to do that, there is something we need to compute which is very, very important, and that is something known as theoretical ex-right price. Theoretical ex-right price. Now, in our case, when talk about the theoretical ex-right price, we say that this is a price which is expected to prevail in the market after the company make a right issue. Now, in terms of how we compute this particular price is very simple, though we do have different approaches which may be used. So what we need to do, we are told that the shares which were issued during the right issue were 150, and then what we know is that the shares which had been issued by the company before the right issue was made were how many shares? Were a total of 400 million plus 500 million. So therefore, what we do is that we take now first of all the shares which the company will have issued before the right issue, the shares issued by the company before the right issue. So in our case here, if you take on the total shares issued by the company before the right issue, we should take the shares which had been issued at the start of the year plus the other shares which were issued here. When taking these shares which were issued on 1st November 2017, we don't take 75 million because this has been weighted on time basis. Rather, we take the actual shares which had been issued before on that date. And in our case, they were 100 million. So therefore, the total shares issued before the right issue were 400 million plus 100 million. So that should give us 500 million. And then what we need to do is to multiply that with the price per share before the right issue, of which in our case we are told the price before the right issue was 2 shillings per share. So we multiply that and we get 1,000 million. So this we refer to it as market capitalization. This is the market price of the total shares issued by the company. Then we take the shares which were issued by the company during the right issue. Now, if you go back to note number 2, we are told that the shares which the company issued during the right issue were 150 million, and then we are told that the shares were issued at 1.5. So we multiply the 2 and this should give us 500,000 500 million, that is times 1.5.